I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a healthcare giant. Our global population is growing larger, older, and richer. What does that mean? It means more older human beings walking around who will likely need and be able to afford quality healthcare. That plays right into the hands of this business, and it's why its revenue, profit, and dividend should all continue to head higher over the coming years. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Medtronic PLC, which appear to be trading at a significant discount today. Medtronic PLC, stock ticker MDT, is a global developer and manufacturer of medical devices for chronic diseases. Founded in 1949, Medtronic is now a $111 billion by market cap healthcare behemoth that employs 95,000 people. The company reports results across 4 segments: cardiovascular, 37% of fiscal year 2023 revenue, neuroscience, 29%, medical surgical, 27%, and diabetes, 7%. Medtronic's product portfolio is comprised of a variety of life-saving and life-improving medical devices that include implantable defibrillators, heart valves, insulin pumps, glucose monitoring systems, pacemakers, stents, and surgical tools. Not only is Medtronic's product portfolio broad, but it's also dominant. Morningstar puts it like this, and I quote, "Medtronic has historically held roughly 50% share in its core heart devices. It's also the market leader in spinal products, insulin pumps, and neuromodulators for chronic pain," unquote. Healthcare is one of my favorite areas of the economy to invest in. That's because healthcare demand is uncorrelated with economic cycles. One's demand for healthcare is uniquely tied to one's health. If one has a serious health issue, rectifying that issue is all that matters to that person at that point in time, no matter what's going on with the economy. Since health issues are a common feature of the human condition, human bodies slowly deteriorate as they age, of course, there is a constant base level of demand for healthcare purely from a human existence standpoint. Plus, healthcare products and services usually feature inelastic demand. The spending on these products is usually non-discretionary in nature, especially if it's a life or death circumstance that does not lend itself to price sensitivity or on-the-spot negotiation. If something like emergency surgery is suddenly called for, one is naturally far more concerned with survival than the exact pricing of the medical devices needed to save one's own life. Another aspect of healthcare that is highly appealing for long-term investment: demographic trends. First, our global population is growing. Second, people are on average living longer than ever before. Third, the wealth of the average person continues to rise. A greater number of older and wealthier human beings walking around nearly guarantees more demand for quality healthcare in general, and Medtronic's industry-leading products with inelastic demand in particular. All of this is why Medtronic should continue to grow its revenue, profit, and dividend for years to come, just as it's been doing for years already. To date, Medtronic has increased its dividend for 46 consecutive years. That lengthy and impressive track record easily qualifies Medtronic for its status as a vaunted dividend aristocrat. In fact, it's nearly a dividend aristocrat twice over. The 10-year dividend growth rate is 9.8%, and that is quite strong, although more recent dividend raises have been in the mid-single-digit range. On the other hand, the stock's yield has been recalibrated by the market and adjusted upward in order to compensate for that slower growth rate. The yield is now at 3.3%. If you've been following Medtronic for a while, you'll notice how unusually high that yield is for this stock. For perspective on that, it's 90 basis points higher than its own 5-year average. Less growth, but more yield. And for investors who lean more toward income, that might be a very acceptable trade-off. Moreover, as I'll delve into later, I don't think this slowdown is permanent in nature, and a higher growth rate in the near future may force the market to readjust the yield back down to its historical norm. That kind of adjustment would require the stock price to go higher, and that's where the near-term opportunity could be. With a payout ratio of 53.1% based on midpoint guidance for fiscal year 2024 adjusted EPS, the dividend appears to be as secure as ever. For investors seeking an above-average dividend from a dividend aristocrat, this is a pretty interesting setup. Looking at business growth, Medtronic advanced its revenue from $17 billion in fiscal year 2014 to $31.3 billion in fiscal year 2023. That's a compound annual growth rate of 7%. I'm usually looking for a mid-single-digit top-line growth rate from a mature business like this. Medtronic more than delivered. But it's important to keep in mind that a major chunk of this revenue growth resulted from the acquisition of Covidien plc in 2015 for almost $50 billion. This complementary addition to the company, with Covidien focusing on endomechanical instruments adding to Medtronic's cardiovascular and orthopedic offerings, gave a large boost to the business in absolute terms. Relative profit growth on a per-share basis should better inform us, especially since Medtronic used equity to help finance the acquisition. Earnings per share grew from $3.02 to $5.29 adjusted over this period, which is a compound annual growth rate of 6.4%. Even during a tough stretch, Medtronic still put up decent numbers. This business could have done better if not for two serious headwinds, one of which is not the company's fault. First, Medtronic's outstanding share count increased substantially as a result of that large acquisition, making growth on a per-share basis more difficult. Second, the pandemic negatively affected Medtronic in a major way. The overwhelming focus on the pandemic by the global healthcare complex led to the delaying of anything that could be delayed, such as elective surgeries. Worse yet, key product launches coincided with the onset of the pandemic and the lessened demand. In addition, the pandemic made it difficult to bring new supply to market. What this means is Medtronic has faced challenges both on supply and demand. But there are silver linings here. Surgeries that could not be performed previously are almost certainly demand deferral, not demand destruction. Those delays could be causing pent-up demand, which would be a strong driver of accelerated growth for the business over the next few years. Furthermore, the arrival of new products to the market precisely at the same time as rising demand could be a potent mix for the business, turning a former headwind into a new tailwind. Looking forward, CFRE believes that Medtronic will compound its earnings per share at an annual rate of 4% over the next 3 years. CFRE seems to be assuming that effects from the pandemic will linger for a bit longer. Indeed, CFRE states, and I quote, "We also see growth around 4% in fiscal year 25, with pandemic disruptions to supply and demand finally ending in our view," unquote. I suppose the key question for long-term investors is this: what kind of growth is Medtronic capable of delivering over the next 10 plus years? This is obviously a very difficult question to answer, but I don't see why the business can't do at least as well as the last decade, a very troubled and challenging period for the business that includes a global health crisis, which is unlikely to repeat again over the next decade. Seeing as how the last decade was really quite respectable in spite of the pandemic, that actually bodes pretty well in my view. All that said, near-term catalysts, pent-up demand, and new products are present. CFRE dives into this a bit. Again, and I quote, "We expect strong results from Medtronic as its healthcare provider customers serve pent-up demand for procedures that had to be postponed due to the pandemic and then subsequent staffing shortages at medical facilities." Medtronic also stands out from medical device peers because of its product innovation and new launches, which drove market share gain during the pandemic and should continue to do so over the long term. One product line that has particularly immense potential is Medtronic's robotic-assisted surgery platform, which we see ultimately being adopted worldwide, up from around 13 countries using the technology in fiscal year 23, unquote. The robotic-assisted surgery platform CFRA is referring to is Hugo, and it's quite a promising release. The near term is shaky, whereas the long term still looks good. I wouldn't expect much in the way of dividend raises over the next year or two, and that's okay. If Medtronic can simply get back to where it was before the pandemic hit, that should set up the business for high single-digit dividend growth over the next decade or so, starting off with a 3% plus yield, which pays investors to wait for that turnaround to play out, quickly paints a picture where 10% or so annualized total returns are realistically achievable before factoring in any kind of multiple re-rating from improving operations. And that's not bad at all. Moving over to the balance sheet, Medtronic has a good financial position that should strengthen over the coming years as the business normalizes. The long-term debt-to-equity ratio is 0.5, while the interest coverage ratio is nearly 9. Medtronic ended last fiscal year with nearly $8 billion in total cash on hand, while the long-term debt load of approximately $24 billion is not overly concerning for a business of this size. Profitability is only so-so, and I'd really like to see pronounced improvements in this department. Return on equity has averaged 8.4% over the last 5 years, while net margin has averaged 14.1%. I like the margins, however, Medtronic has been putting up single-digit return on equity and return on invested capital for most of the last decade, and that's basically right in the range of WACC, making it difficult to generate excess returns. Medtronic has a lot of wood to chop here. Medtronic has undoubtedly lost some of its shine, but a firming of demand from catch-up procedures could quickly return the business back to some of its former glory. And with IP, R&D, switching costs, economies of scale, a global distribution network, high barriers to entry, and a diversified portfolio of entrenched products, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. All three of these risks are elevated for this business model in comparison to many other business models, in my view. Any changes in the way healthcare spending is managed, especially in the US, would almost certainly impact the company. Medtronic occasionally recalls products, which involves costs and possible damages to reputation. Demand for medical devices is fairly disconnected from economic cycles, but a recession could cause people to delay or cancel elective surgeries. Any major technological changes in medical devices can alter the competitive landscape, which pressures Medtronic to constantly innovate and stay ahead of the tech curve. The rise of GLP-1s may reduce or even eliminate a range of health issues, and this could lead to less demand for many medical devices across the board. There are some risks here to seriously consider, but the valuation, which looks attractive after a 35% plus fall in the stock's price from its all-time high, should also be seriously considered. Stock is trading hands for a forward price earnings ratio of 16.5 based on midpoint guidance for this year's adjusted earnings per share. That is not egregious at all for a business of this stature, quality, and market positioning. Sales multiple of 3.5 is well off of its own 5-year average of 4.3, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. To be honest, this is a tough one to gauge. If we go by Medtronic's longer run numbers, a high single-digit dividend growth rate isn't an unreasonable expectation at all. If anything, 7% is selling the Medtronic of old, sure. However, since the big acquisition and the pandemic, Medtronic has been struggling, and the new weight loss drugs throw a wrench into things. I'm giving Medtronic the benefit of the doubt here, assuming the business can return to some, but not all, of its former glory. The dividend discount model analysis gives me a fair value of $98.44. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates MDT is a 4-star stock with a fair value estimate of $112. CFRE rates MDT as a 4-star buy with a 12-month target price of $98. I came out very close to CFRE's number. Averaging the three numbers out gives us a final valuation of $102.81, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Medtronic PLC is a great healthcare business benefiting from favorable demographic trends, secular growth, and pent-up demand. With a market-beating yield, high single-digit dividend growth, a moderate payout ratio, more than 45 consecutive years of dividend increases, and the potential that shares are 17% undervalued, this dividend aristocrat is a prime investment candidate for long-term dividend growth investors looking to up their healthcare exposure. And now for a special news announcement. General Dynamics Corp, stock ticker GD, just increased its dividend for the 33rd consecutive year, this time by 7.6%. This dividend aristocrat continues to get the job done. High single-digit dividend increases come in like clockwork, especially with the way geopolitics are right now. The stock has gone on a bit of a run over the last year, but the valuation isn't super demanding, and it's just such a great long-term performer. We're talking a gain of 7,000% over the last 4 years on the stock price alone, plus dividends. If you don't yet own any General Dynamics, now might be a good time to change that. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check out the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.